50 YouTube subscribers, you're going to have access to the live stream and the record. I don't think that this recording, even though I'm going to stream it live at YouTube, I do not think I'm going to send it to, I don't think I'm going to publish this recording because some people may be talking about their personal finances and it's going to be pretty much a one and done here. We'll do another one maybe in a couple of months where we do it like this at such a large, well, open to such a large group of people. So I'm going to now, for those of you listening to the YouTube live stream, you know where to register. Let me see here if I can put the comment on our YouTube. Okay, register. Okay, there we go. So if you guys are tuning in on YouTube, we got about 5 more minutes. We're gonna go live in around 5 more minutes before I bust out the slides and we start getting into things. What we're gonna do as far as the format is, I'm gonna present on these topics. You guys are going to be listening, and at the end we're gonna do some Q&A. Looks like we got some other tax accountants here as well, which is totally cool. And we'll dive into some of the things that we are doing. Let's see here. Okay. Sharma, how you doing, alrighty? Okay. So we got another one here.
Well,
Hey, how you doing? We're gonna go into, I'm gonna show some slides in a little bit, and we're gonna jump into things.
sure.
Good to see you, Jocelyn, Vic, Patra. We are gonna go in about, I'm gonna give people about another 5 minutes, and then we'll jump into this.
How long is this?
I don't know.
I'm just driving it.
But if you have any questions, I'm gonna go into some high level things that we should be thinking about at the end of the year. And if you have any questions, you're gonna get a chance to ask them uh in the either we'll be able to talk or we'll just shoot me a message or an email after if you have any outstanding questions. Okay, let's see what we got here. All right, we got a couple more people. Here we go, going live. All right, you guys, now you want to maybe take out whatever you need to take some notes. I am leaving the Instagram live stream in 5 minutes. Make sure you register here so I can talk to you and continue the conversation.
Are you saying we should register on Instagram?
No, no, no. For the people listening on Instagram right now.
Oh, we're good here, right?
Yeah, yeah, yeah. All right, you guys. So Instagram people, make sure you register on that link there. I'm about to turn out. Oh, we got someone, Chris McGuire. How you doing? Yeah. Hey, log into the YouTube. You see there, I put the registration link. Go on YouTube and we'll talk. Awesome, dude. All right. Have a good one, man. Cool beans. Oh, we got a couple more people coming in, and we're gonna start at 6:05. Okay. All right. You guys ready to get into it? Let's do it. Save your questions for the end. We're going to go through some quick concepts here for some of you guys, and we know a lot of you guys, it's hard to find people to advise you and be strategic on your taxes. So, let's see here. Here's some things I want you guys to be thinking about. Share my screen here. All right, you guys. So here's what we're going to talk about today, and then I'm going to answer all your questions on these topics. We are going to discuss first we want to think about when we're talking about maximizing our tax savings for year end. First thing we want to think about is we want to understand our numbers. What is our profit? So we're going to talk about some strategies to making sense of the numbers and your profits here. Next, we're going to talk about maximizing your tax deductions and your basic concepts here that we do with our clients. And then finally, we're going to talk about opportunities for real estate investors and why it is so great to be a real estate investor. But by the way, I am offering consulting for other accountants in case anybody's wondering some of the things that we're doing. Strategies for, then we're going to talk about entity planning. So some year-end stuff involving entity planning and maximizing the benefits of your entity planning. Strategies for high-income earners. And then it's not just about creating tax savings, but how do we create future tax savings? So it's not just about reducing the tax bill on the 1040. This is also about how can we prevent future taxation? So what do we do now to prevent taxes in the future? And then we're going to go into some action items that you guys can take so you can be on top of all of these things that we're talking about here, making sure that you are being proactive with your taxes here. And then we're going to talk finally about, we're going to get into some Q&A, and this is all for the people. Actually, 1 second here. This is for everyone to make sure that you can actually, you're not just going to sit in another boring webinar and just hear stuff that you don't use. This is to make sure now, and it doesn't matter who you are. This could be if you're just, these are the people it applies to you. If you are an entrepreneur of any kind, if you have a high W-2, and I'm talking about probably over $600,000 of W-2 income, or if you have any business at all, these are things that you guys should start doing immediately to make sure you're being proactive with your taxes right away. And then we're going to go into some Q&A. It sounds like a lot of bullet points, but trust me, we'll make this short and sweet so we can get into your questions here. So first things first, I want to talk about understanding our books here. So the number one thing you guys need to do, you need a general understanding of what your profits are looking like in your business. Not your revenues, but your profits. So your revenues minus your expenses, because we can't do anything at all until we know how much profit or taxable income is going to be rolling onto your 1040. So one of the things you want to do is make sure you have clean books. Obviously, if you have a bookkeeper, it'll save you so much time. Don't dabble in bookkeeping, guys. If you're a real entrepreneur here, you're here to hustle and make a difference in the world. You do not want to spend your time classifying transactions and reconciling bank accounts unless you're a classically trained accountant. So get someone on your team. Now, some of you guys just starting off, you do not need QuickBooks. You do not need bookkeeping if you're just starting off. And so I want you guys to email me, info@markperlbergcpa.com. We have a template with instructions on how you can take your bank statements and how you can turn that into an income statement and start projecting what your profits are looking like for this year. Now, for some of you guys, all you can, we're going to show you a video instruction in that if you email me, I'll send you the template. You can export.
Well, that's why I was thinking to head out here shortly and run to the stores, and I can just text you when I'm leaving Home Depot.
What?
Does that work?
What'd you say, Carrie?
Oh.
Okay, she's going to Home Depot. That's great. But make sure you get the 10% discount with the card. All right, that's what matters here. So, what you can do now is if you don't have QuickBooks, I want you guys to export all of your transactions that relate to your business into Excel, place into our templates, and now you can start getting an idea of what your profits and losses are going to be looking like for the year. And that's pretty much baseline what we got to do to understand how much potential tax liabilities are we looking at for the year. So we know where we plan for. Are we planning for a couple $1 million in taxes? Well, that's going to involve some more sophistication than if it's maybe $20,000, $30,000, $40,000 in taxes. So that's the first thing. And then we want to maybe also consider what are our profit margins relate to our revenue? How is our revenue growing? And what do we expect next year? Because if you really want to have a tight strategy here, it's not just about planning for this year's taxes, but understanding where your income is going. Maybe you're on a downward slope. Maybe next year you're going to bottom out. Well, that also is a tax planning opportunity. Maybe we shift some income into that lower tax bracket year. So even if you are anticipating losses, there's great opportunities to build some tax-free income and wealth here. So once we got an idea for the tax treatment and taxable events here, we want to think about maximizing our tax deductions here. So you want to understand what is in the eyes of the IRS ordinary and necessary in the eyes of the IRS. So basically what we need to say here is what is to be deductible, an expense that needs to be ordinary in your regular form of business and necessary, but it does not absolutely have to be indispensable to be necessary. So for some of you guys, yes, you can write off the appetizers in your meals. There's so much flexibility for what you can deduct here. You can have trips where there is some element of vacation in it, but still write off the entire trip. So make sure that you at least have a base understanding of what you can deduct in your business, because before we go into any strategies and any fancy entity shifting and all these things that we do for our clients at the very basic level here, we want to make sure we're at least getting our tax deductions for the money we're spending to further our business. And if you have a solid understanding here, you may find ways to create additional tax deductions out of ordinary events, such as meetings with your spouse if they're business related in your family. You may also be able to find additional deductions here by creating some year-end expenses. So some of the things I'm highlighting here is you want to think about, obviously, the home office deduction. That's not so sexy, though. Let's move past the home office. Business travel and meals. I love this one because I travel a lot. I probably have about $50,000 in business travel and meals. And I go to lots of conferences where I'm with wonderful people, learning, growing, and having fun and exploring and going to the beach. Depreciation is a really big one. And if you really know and are proactive here, a huge strategy for our clients is how can we create some year-end depreciation? So like we had one client at about $1 million AGI. And what we decided to do here, before we decided cost segregation studies and other more sophisticated vehicles, we found that it actually made sense for her to buy some more equipment that she can lease out to her contractors. And she spent about $600,000 just on trucks. So right there, that gives us 80% bonus depreciation. And that gives us about a $4,800,000 tax deduction. So we've already eliminated close to half of her taxes by doing just some year-end purchases. So understand where we can maximize depreciation. Putting a vehicle into your business gives you a nice depreciation deduction. Buying heavy equipment, all those things are really wonderful year-end deductions. Also, let's talk about maybe we could prepay some expenses, getting those expenses in before the books are closed. What can we write off at the end to make sure that we get those deductions as soon as we can? And here's what I'm just throwing in as a bonus, and we'll talk about this more later, is oil and gas. Oil and gas investing is a strategy we're exploring with our clients. This is really good for real estate investors who can't find good deals, lost their rep status, and are tired of dealing with the 3 T's, tenants, toilets, and trash. You put your money to the oil and gas, you'll get a tax deduction at around 80 to 90% of the cash invested. And then you get future cash flow. So all these ideas where we can get some last second deductions in before the year ends, and make sure you've explored and understand these things with your advisor and you got all your deductions in, you can recognize them. And here's a little hint for you. There's this legend out there that you need to have the expenses going out of your LLC to be tax deductible, or you need you need the LLC before you have any write-offs, and that's absolutely false. If you capture any deductions that you accidentally put in your Amazon card or whatever, make sure you can find those amounts and deduct them right away. So next, I want you guys to think about capital gains events. So now save this for the Q&A. I want you to tell me what kind of capital gains events do you have or are considering having. We can, even with real estate, we can net losses from our stocks against real estate capital gains. We can net losses from our stocks or even our cryptocurrencies against gains from stocks, real estate, and sales of the business. I love crypto because we don't have to worry about the wash sale rules. Create those losses and write it off. So that's one of our lower hanging fruits if we have some capital gains going on. Timing here. If you're thinking about selling some stock to get some cash, think about the favorable long-term capital gains versus short-term cap gains rate. You may be able to stretch this out and wait a little bit to see a more favorable tax treatment here. We can create some losses here. So if you are a business owner and you have capital gains, maybe deploy some of these funds into other areas where you get tax deductions being deducted and offsetting your income being taxed at a marginal rate to create a favorable position for yourself. If we have a failed 1031 exchange and you're wondering what we can do, buy some real estate, consider some cost segs, collaborate with your advisor on how we can offset this real estate capital gain event. And also, it's not too late at the end of the year to consider qualified opportunity zone funds. We have 180 days from that capital gain event, and it can be any type of capital gain. You have 180 days. You can even do it after the year has ended to defer the capital gains on any event. And finally, some charitable structuring. If you there are still some ways where we can use some advanced charitable structures to offset some capital gains. But the capital gains events have already occurred. We probably can't do a whole lot there. Now let's talk about some foundational things for you real estate investors. So for you real estate investors, we have depreciation, cost segregation, and bonus depreciation. Depreciation is one of the beautiful things about real estate. It's going to allow us to have a cash flow positive business income, and the depreciation is going to come in and offset all of it. And we can maximize our depreciation with the cost segregation study, shifting that depreciation up and creating tax losses that may be able to be used by you. And also, we're going to get some bonus depreciation additionally, just giving us that additional chunk of losses there that can be used to offset real estate capital gains. If you have short-term rentals, you can offset your ordinary income, or maybe you have real estate professional tax status where you work full-time in real estate, and that could also offset your ordinary income. Lots of different ways that we can spin this if you understand the tax treatment of real estate and how to take advantage of it. So if you are in real estate, make sure you're considering these things among your strategies at year end and how that's going to impact you on your taxes. Now, I expect some questions on all these topics because I'm just talking about it high level, and then I'm going to answer your questions as it pertains to these things. Next, let's talk about entity structuring here. Now, I'm going to keep this high level. S corporation, if you have active income and you're probably, the way I see it, you want to be making at least over $80,000 to $100,000 a year in profits to take advantage of an S corp to offset your self-employment tax. And now let's think about this. This is why I put it later in the slide. First, we want to make sure we maximize our tax deductions. We may be able to eliminate or bring your taxable income very low as far as the source that is subject to self-employment tax. But let's say we're still in 6 figures of active income subject to taxation. The S corporation is going to allow you to mitigate your self-employment tax at 15.3%. And finally, we have our pass-through entity tax election. If you are in a state that charges income taxes, This is going to allow you to deduct more than $10,000 of it against your federal. Each state is different, but this can be a huge opportunity. And most accounting firms do not have the understanding and resources and time to dedicate into this strategy. We're finding it's created anywhere from tens of thousands to up to $100,000 from our higher income earners. So it's really important. It's for some of you guys, you're going to need to make some transactions. You're going to need to make some estimated payments and elect that certain state level, pass through any tax election to make sure you can get that extra tax deduction, and it can be pretty valuable. Other things I want you guys to think about: if you are a high income earner, there may be opportunities for advanced entity structuring, special partnership allocations where the losses are going to flow through onto one partner more than the other, maybe create additional entities and spin-off entities, charitable deduction strategies. There's several of them out there where you're going to get a deduction that is greater than the amount of money spent to get those deductions, either due to the valuation of the asset you're deducting or the timing of when you get the tax deduction. So, we have strategies that can offset anywhere from 30, some that'll offset 30% of your income with minerals and natural resources. We have what's called a historical facade easement that'll offset 50% of your income. And then there are other ways where we can have charitable structures that'll offset 60% of your income and potentially offset 99% of your capital gains income. We have, in addition to that, you want to consider potential tax credits. We're working with a client to offset Pennsylvania taxes with a tax credit at 80 cents per dollar, where you're paying up front and you get to purchase the tax credits. And then we can also consider additional businesses that we can facilitate that are easy to run and are going to give us access to large chunks of bonus depreciation. These are for really the people at seven figures where we have the opportunity to be a little more resourceful here. All right. So now that we've done everything to maximize your taxes, if we find that you are in a very low tax bracket, here's what we can do to further create some tax-free wealth. Because it's not just about creating immediate savings. These have to be long-term strategies. We don't want to do something that's going to create tax savings now, but you're going to find that you're getting hit in the head with taxes later. So here are some vehicles that create future tax savings. If we found that we brought you into a really low bracket, take advantage of the low bracket and roll it into a Roth. We had one client operating at a loss who had a couple million in real estate. We knew they weren't paying taxes, but our job wasn't done. We actually decided to do a cost segregation study and drive their income into a negative amount. And that negative income allowed us to roll their 401k all over $250,000, about $300,000, into a Roth IRA. The losses from the real estate offset the money out of that 401k. Now this 401k is going to grow tax-free. If we didn't do it, that 401k grows and accumulates 300, becomes 400, becomes 600, because of millions of dollars that is eventually going to be taxed when the money comes out. Now it's going to grow tax-free in the Roth, and the money gets taken out tax-free. So we're being proactive and capitalizing on these business losses. Life insurance is a beautiful vehicle to build up your tax-free wealth. Income shifting income to your family members, gifting stocks, or maybe you can hire your family members. Tax advantage investments like oil and gas, real estate, where the depreciation offsets your income. You don't need rep status. You don't need to be full-time in real estate. You could be passive and invest in other syndications and still see the benefits of depreciation and tax-free cash flow. And also other tax advantage investments that you can consider, where invest in funds that are going to have tax advantages, like ATM syndications, or you can invest in, talk to us and we can share with you some of the people we work with that create tax advantage funds for their clients and investors. So as far as action items and next steps, I want you guys to join our free community if you haven't already, where we do some It's just some free live Q&As every now and then. I'm eventually going to have some courses in there, and it's going to be just, we're gradually building a small community where eventually, this is especially true because we're trying to offer and help everyone we come across. So we're going to do a one-to-many course format for anyone looking to learn more about tax planning, and really give you some essential tools here and learn the foundations. For those of you who know you're paying a ton in taxes, if you've paid over $100,000 in taxes per year, we have a promotion. I'm putting the link here. In 10 minutes, we will help you find $50,000 of tax savings. So here's a link to my calendar. If you qualify, book it right there. If you are interested in our services, email info@markperlbergcpa.com, and we can continue the conversation. And also, we have a 10-minute link here if you want to have just a quick conversation with a couple of members on our team. This will sync to several members. You can click there and you can have a quick conversation with anybody else about your situation to see how we may be able to help. And finally, I have your information. We're going to put everybody on our mailing list, and you're going to see some of our upcoming free webinars and all our news articles where we're talking about some of the strategies and concepts we're diving into. All right, so that's really all I want to share with you guys. And now, if you have any questions, here's your chance for some free Q&A from the audience. So I want you guys, I went through this pretty quickly because I wanted to give you a chance to see if there is anything that you think resonated with you that you would like to answer, have me answer on. So give me I want you to raise your hand in the chat if you have any questions about any of these topics at all. Chris, you're first. What's up?
Oh, I heard like an echo there for a minute.
Here we
Okay.
go.
Cool. So yeah, I started a software company this is my second year with it. I've done a lot of what you talked about, so I'll tell you what I've done so far. So I have an LLC. I changed it to be taxed as a S corp. Maxed out the solo 401k, Roth IRA, all that. That, and then no real estate or anything like that. Very small amount of capital gains from some mutual funds that I've had forever. Just wondering what would be like the next thing to look at.
So what made you decide to max out your solo K?
Just to try to lower the the income that I'm recognizing.
Okay. And what are you looking to do with your cash?
I would ideally just something low maintenance. So I've just been buying ETFs. That's what I've been doing for the most part.
Now, I would have to look at what your profits are, but here's the thing. Now, I think that the solo 401k is good here, but the challenge we have with the 401ks with our entrepreneurs, a lot of our entrepreneur clients, they want to have access to their funds sooner because, you look like you're under 59 and a half. And we don't know what bracket you're going to be in there. And eventually you're going to be paying taxes when the money comes out of that solo 401k. And there's a limit on how much we can put into that thing. So, I think first off, we want to make sure our foundations are in place. Have you considered R&D tax credits?
I'm not, was that the oil and gas that you shared?
That's research and development for your software company.
No, I haven't looked into that at all.
Okay, so you want to look at the expenses to develop this software, and you can connect with a specialist. Some firms will do it, and some will consult with a specialist, like an outside consultant, to see if it's possible to get any research and development tax credits. Here's just some of the low-hanging fruit. I don't think if you're doing software, there's probably not a whole lot of bonus depreciation. It's not likely you'll benefit from buying a pickup truck.
Right.
So the depreciate, the tax deductions are nice. I'm not sure how much meat on the bone there is, but what I really like for people you're looking for a place to park your cash, great tax savings and passive income, right? So that's why um I really like the oil and gas investing, because you're going to get future cash flow that you can access, and you're going to get an immediate tax deduction. So that's one way. And then if your income is over a certain amount, so if let's say your income is over 500,000 and up, there are other strategies where we can create other businesses that create bonus depreciation. You can invest in short-term rentals to access depreciation on the rentals to offset your income. That's going to take some that may not be worth your time though. Are you interested in getting involved in real estate?
Um, I think the way the market is right now, no, but I mean, that could change.
Yeah. So I think that if we look at your income, we can explore some charitable deduction strategies where the amount of cash that it costs is less than the tax savings created from the charitable deductions. So that's a way where you can get immediate tax savings that you can reinvest into your business or reinvest into stocks, or maybe even roll some of your 401k into a Roth and grow it tax free. You can also, and I really like oil and gas, and I have two webinars I did on oil and gas. One with Steve Blackwell and one with Ray Trevino. And if you just search my site or my podcast, you'll hear our conversations where you can learn more about that as well, where you're going to get cash flow, access to your cash, and immediate tax deductions, and you do nothing at all.
So with those investments, do they have something low maintenance like a REIT or equivalent for the oil and gas investing, or is it
It's
what does
all,
that
yeah,
look like?
it's all passive. So you invest as a limited partner. You're not involved in any of the decision making. They're going to do what's necessary to generate profit from this. But let's say you have $100,000, you're getting $80,000 tax, $80 to $90,000 tax deduction up front. And then what we've seen from our clients is an ROI of about 20 to 40%. And what we also see is that some of the cash flow is offset by depletion. So that's the wearing and tearing down, the wear and tear of the land itself. So you're still going to be receiving tax advantage cash flow from that investment.
Is
Cool.
this
And
a
sorry,
very auditable thing? Like, is it very highly audited like the oil and gas? It sounds too good to be true in a way.
Yeah, so for our clients, there's a spectrum of how aggressive you want to be, and some of our charitable deduction strategies vary. And I'll be honest, some of our strategies are going to be audited, which is not bad. It's not some we're going to show our clients, and we're not going to say you should do it or not. We're going to help you understand what's the risk, what's the probability of a correction in the valuations, and how much is this going to save you in taxes, and is it worth it at the end for you based on your tax bracket and the savings we'll create. But for oil and gas, this is not a controversial, aggressive, gray area type of strategy. We're just taking advantage of an incentive written into the tax code that is meant to encourage people to further energy production, just like they have solar energy tax credits. So if you're investing in oil and gas, this is one of our more traditional and one of our more conservative strategies, but it still creates a lot of tax savings and cash flow and wealth for our clients.
Can you give an example? If you give, let's say, do $100,000 contribution, how much income offset do you get, and when would you get that 100K back?
Okay, sure. Let's keep it simple here. Okay, let's say you're a high income earner. You're in a 40% tax bracket. You live in California and you're just getting hammered. So maybe even 50%. Let's say 40%. Keep things simple. You put $100,000 into a fund with oil and gas. You write off 90% for what's called intangible drilling cost deduction in year one. You get a $90,000 tax deduction, and you're at a 40% tax bracket. So in year one, you pay $90,000, you get a 36%, you get $36,000 in tax deductions, 90,000 times 40%, right? In year two, let's say you get a 20% ROI here in your cash back. So you spend 90 in the first 12 months. Let's say if you did this at the end of the year, because we're talking about year end. In the first 12 months, let's say We save $36,000 in taxes, and then we get our 20% ROI. So 36 plus another 20, that's $56,000 returns to you for your $100,000 investment. And I've seen ROIs. Now I don't know what to expect because I haven't seen enough of this. Our clients are now just jumping in as some of them are getting burnt out or can't find real estate deals. But I've seen ROIs as high as 40%. So and the intention here is to double your money in about 5 years or so with a well-operated fund here. So pretty soon, in the form of tax savings and cash flow, you've already received back your capital. And this combines really well with real estate. So let's say you don't have rep status, but you have some depreciation and passive losses. It'll carry forward and offset your oil and gas deductions.
I see.
So
We
the
had
investment needs to be finalized by the end of the year, right? How practical is that? We've only got a week left here.
Yeah, we don't have a lot of time, but I just actually was just on the phone with one of my colleagues, Steve Blackwell, who I interviewed as well, and you can listen. And I think he has until about the 29th, believe it or not, to accept investments into the fund.
And then, is there similar tax advantage funds with solar too, to like diversify that, or have you looked at those?
Sorry, hold on a sec. I'm trying to, how do I get rid of my share on this Zoom? I always try to, I never can find where it is when I want to stop sharing my screen.
Go back to the share and say stop share.
Yeah, where does it say share though?
Share it should be at the bottom. There should be an arrow, and then you just say stop share.
No, it's top right.
Oh, I see it
You can
right
see
here.
it. Yeah.
Got it. Okay. The solar, so we have one strategy that involves creating tax credits with investing in solar. If you have passive income, you can do it before the end of the year. If you're looking to offset active income, it's too late. This is a strategy really for next year.
Mark-
With something like a software company, can I classify some of the income as active and some as passive, or how does that break down?
For you, it's going to be all active income, most likely, because you're involved in all of that day to day and working full time. Now, if you are at a certain level of income and sophistication, we may be able to create some spin-off entities down the road and have a passive income generator that serves your business that we can break out. But you would need a bona fide business purpose. It's unlikely that's going to happen anytime soon. We've explored it. We're open to it, but it's not often that we get to create passive income out of your normal source of ordinary income.
Okay, cool. All right, that's all I had. Thank you.
Cool, dude. Yeah.
Mark, the 20,000 that you talked about, so the 36,000 was a depletion, the 20,000 was return, so it was cash you received.
Yeah.
Would that be taxable though again?
It would be taxable as passive income, but some of it wouldn't be taxed and would be offset by depletion. And I believe some of this would be return of capital. So we're going to see a handful of K1s, and we'll gain a greater understanding of how much of this is actually taxable in year one and how much of this is just a distribution.
Okay, and so in the year 4 or 5, the 100,000 that was put in becomes 200,000 is what you're saying.
Yeah, eventually, when it runs its course, you're going to get distributions that should be in excess of your contribution by at least 2x, hopefully more, depending on the investment.
Okay, thank you.
But it really just depends. I can't make any promises, but we're going to be looking at we're going to see firsthand how a lot of these turn out this year, because a lot of our clients have taken interest in this, which is pretty exciting.
Is this a W-2 high income earner a good candidate for this strategy?
Yeah, well, you got to be an accredited investor. So
You're accredited, but just a W-2 income.
Yeah, I think it's great for W-2s because they don't have access to as many tax strategies. So you get someone who has a high W-2, and maybe short-term rentals was their go-to strategy in the past. Let's say, they have all this money, they're paying all this taxes. They're like, what can I do? Well, we still have the ability to invest in oil and gas.
Okay.
Which is pretty cool. What is the minimum oil? So the minimum I've seen, I believe they want to see at least $50,000 going into oil and gas. I've seen it. I've seen them accept as little as 25,000 if you ask, but I think they'll typically say 50,000.
Okay, so can we reach out to you offline to get connected to those opportunities?
Yeah, shoot me an email, mark@markperlbergcpa.com if you want to get an introduction to our resource. Now, also you can watch my content, and their contact info is in the podcast and the YouTube webinar. But shoot me an email, and I'll send you back the links and the contact information for these guys.
Thank you. You also mentioned ATM investments.
Oh yeah, those are cool because, we don't have to think about cost tags. Those ATM machines are going to qualify for bonus depreciation, all those assets. So your first few years, you're going to operate at a loss because of all that depreciation you're going to get in the ATMs. And then you get your cash flow. You may get a return of some of your capital contribution, and then you reinvest it into more funds that are going to generate more profit and depreciation.
Okay. Thank you.
Very cool, right? And actually, if you're interested, I'll send an introduction to one of my friends who does syndicate ATM machines.
Mark, can you do that for all of us, or do we
Yep.
need to let you know? That'd be great. Thank you.
Just email me what you would like to know, and who you'd like to meet, and I'll make it happen.
Wonderful. And when you said webinar, where are your webinars?
Just go to YouTube, Mark Perlberg CPA.
So this webinar will also be there?
I think I'm gonna I'm not sure if I'm gonna put this one on there because I did a podcast on year-end planning, but I'll email you guys a recording so you have access. I'm not sure if I'm gonna publish this one.
All
And
right.
where's your community? You said you have an online community.
Yeah, the link is there. I'll be honest, it's not the most beautifully designed community yet. It's a work in progress, and we're eventually going to offer courses for our clients and for other CPAs on it. So it's in the Kajabi universe. Here's a link, and it's free. I just posted it. And
Oh,
what we're trying to do, I think I actually, here, let me post it again. So here's the link, and basically, because we get people all the time, we want to help out. We can't help out everyone. So let's say we get someone who's just starting out in real estate, and we can't really create a whole lot of savings. We can still teach them a lot in a course. So we're going to try to help out everyone we come across, and will allow us to do that.
And your podcasts are on Apple Podcasts and all that, Mark?
Yeah, it's on every major platform. You'll find them.
And it's on your name.
You got it. Mark Perlberg, CPA Podcast.
Awesome. Worth its name in gold.
There we go. Easy to find. Yeah. All right. Any other questions?
what's your recommendation if you don't have any real estate and like W-2 earners less than like around 300 to 400K range and not having any opportunities for any deductions really?
Okay, so yeah, around that. Let me ask you, what's your goal?
Well, want to do more real estate, but this year with the rate environment we're in, was not able to do much.
Yeah, I hear you on that. So you're still an accredited investor. So you can still invest. Oil and gas is still an option. If you want to maintain liquidity, you can consider some others, some charitable, you might have access to some basic charitable strategies that'll create some annual savings. And I would say, short-term rentals, it sounds great, but it actually, it could really suck if you don't want to get involved in that stuff. The juice may not be worth the squeeze. So I think that if you're higher income, like in that 300 to 400 range, I think really your best bet here is, so I might be able to connect you on some short charitable strategies. They probably wouldn't do a whole lot, but I really like the oil and gas, because let's say you're waiting to get real estate in a later year. Well, if you put money into the oil and gas, it's going to give you some tax deductions. It's going to give you cash flow and it's going to build your wealth. So when you're ready to invest into real estate, a good chunk of what you put into the oil and gas will be back in the form of tax savings and cash flow. So it's not like because like when you invest in real estate, a lot of your money goes into the down payment. It takes a while to get it back. Put your money into the oil and gas, you're going to have some cash flow and some tax savings to build some wealth for future investment into real estate. And then even if you don't have rep status, now you can use your real estate depreciation to offset your future cash flow from that oil and gas. So I really like combining the two strategies.
Have you heard of anything like a leverage charitable deduction strategy where you put in like a 25K and you get 4x contribution amount, like a 100K deduction?
Yeah, we're aware of strategies where you can get a 5x, 10x deduction with leverage. So yeah, we're aware of those.
Those look like risky and like a high order risk. Or do you support those, or like what's they look quite risky.
Right. So
Sound risky.
Yeah, so we share the facts with the clients. So if you have like a concert, let's like the big one, the C word is the conservation easement. And a lot of people are afraid of using the C word. But in that example, you get a 5-to-1 tax deduction. Well, if these are all organized by tax attorneys who understand the tax law better than the IRS. And if it's executed properly and you evaluate worst case scenarios are it takes about 7 years to adjust the valuations on these things. And by that time, the tax savings has been reinvested. And also when they adjust them, it's not like they're going to go from a 5-to-1 to like a 3-to-1. They may it's not like they're going to go from a 5-to-1 to like a $0 deduction. They're usually going to settle, or they may go from like a 5-to-1 to a 3-to-1 or 2-to-1. Either way, when you consider the time value of your money, the reinvestment of your tax savings, a lot of our clients, when they find that the savings is significant, they find that it's worth taking on that risk.
So Mark, I'm going to jump in and ask you, if I have a high income W-2 earner and he was to choose between a leveraged strategy, charitable deduction strategy, or oil and gas, which one would be your go-to first?
So it's, to me, it's not even about me. I try to give an unbiased look and break down the numbers, because if you're looking for cash flow to offset your income and eventually retire, oil and gas is passive income where you're making money to do nothing at all. So it's like, let's say you can't find a real estate deal, or like, landlording wasn't your thing. The oil and gas is a really nice alternative. But let's just say you want money to reinvest into your business and you just want cash. Well, the oil and gas is not going to give you immediate liquidity because you still have to put money into this thing. It may take 2 to 3 years or 4 years before you're back at break even with tax savings and cash flow. So it really just depends on what the client's needs and goals are.
And tax savings for sure.
Oh, absolutely. That's one thing for certain, is you'll get the tax savings.
In both of them.
Oh, absolutely. Now your tax savings is greater from the leveraged charitable deductions.
Okay.
But there's no cash flow. It's purely a tax savings game. And why not do both? Like, heck, if you're going to create $25,000 of tax savings and you still have some cash left over because of the net tax savings, why not create some passive income that's going to reduce your taxes at the same time?
Right. Okay. Because of the limits, they usually have higher limits of contribution, and then you have to choose one or the other. For clients that have done these leverage strategies, several of them have done a combination of oil and gas and the leveraged strategies. Okay.
So you can do both.
Okay.
And they're excited about the cash flow they're going to get on these things too.
Right.
I mean, they're going to have to think about it. They're going to get this tax savings. Unless they need the money for their businesses, they got to do something with the cash. And if they don't need it for their day-to-day living, well, they need to invest in something. So they could invest in stocks, which is not bad, but they could also invest in oil and gas. That'll drive down their taxes even more.
So in the first year with the oil and gas, it's really just dollar for dollar. There's nothing additional you get the first year.
Yeah,
The future years, what you get is the cash flow.
exactly. Now, I like the idea of taking your tax savings and cash flow and profits and reinvesting into more oil and gas. That'll create more tax savings.
Thank you.
Yeah. Anybody else got any questions? These are good questions, by the way. All right, you guys. Well, I'm glad that we got some people to tune in. If you know anyone else who can use us as well, just shoot them our way. You can also go to referral@markprobergcpa.com if you know anyone else who may want to learn about some of these ideas and make sure that they're maximizing tax savings. And just make sure you're keeping in the loop, subscribe, and looking forward to sharing some more ideas. All right.
Thank you, Mark.
Absolutely. Great talking to you all, and we will talk soon.
Sounds good. Thank you. Happy year end.